I may not know everything, but I can always find out.
Today, we're diving into how banks really make money and what they don't want you to know.
Have you ever wondered how banks stay profitable while paying you next to nothing in interest? It turns out banks have several tricks up their sleeves to make money, often at your expense. From loans and fees to investments and government policies, we're breaking it all down right now. Banks don't just hold your money, they loan it out to others. When you deposit $1,000, the bank doesn't keep it all. They might hold just $100 and lend out $900 to make a profit. This is called fractional reserve banking, and it's how banks multiply money out of thin air. Imagine a bank balance sheet illustrating how little cash is actually held compared to what's loaned out. Loans are the number one moneymaker for banks. They lend out money at higher interest rates than what they pay depositors. For example, if a bank pays you 0.5% interest on your savings but charges 6% for a mortgage, they make a 5.5% profit. The bigger the loan, like mortgages or business loans, the more money the bank makes. Picture a bank profits counter increasing with each loan. Banks make billions off hidden fees. Overdraft fees can cost you $35 or more when you accidentally go negative. Using an out-of-network ATM might set you back $3 to $6. Some banks even charge account maintenance fees just for holding your money. Wire transfer fees can add another $25 or more per transfer. Imagine a frustrated customer checking their bank statement, seeing multiple fees. Banks use your money to make more money by investing deposits in stocks, bonds, and government securities. They also invest in real estate, corporate loans, and even risky financial products like derivatives. Even though your deposit is just sitting there, the bank is actively investing it for profit. Visualize a timeline showing money moving from deposits to loans to investments. Banks love credit cards because they make money in three ways. First, interest charges. If you don't pay your balance in full, they charge 15 to 30% interest. Second, transaction fees. Every time you swipe your card, the bank collects 2 to 3% from merchants. Lastly, late fees. Miss a payment, and that's another $30 to $40 straight to the bank. Picture a visual breakdown of how a $100 credit card purchase sends fees to the bank. Banks have exclusive access to the Federal Reserve, which gives them low-interest loans. They borrow at almost 0% interest and lend it at 5% or more. If a big bank fails, the government often steps in with bailouts. FDIC insurance guarantees deposits, making customers trust banks more. Imagine a Federal Reserve logo with an unlimited money sign. Banks sometimes exploit the system through predatory lending, offering loans to people who can't afford them, leading to debt traps. Hidden clauses in fine print make it hard to escape fees and charges. Some banks even engage in market manipulation, using inside information to profit from stock crashes. Picture a magnifying glass revealing small fine print in a loan agreement. To protect yourself, consider using credit unions, which often have fewer fees and better rates. Keep an eye on fees by setting alerts to track unnecessary charges. Pay off credit cards in full to avoid high interest rates. Now that you know how banks really make money, what's the worst fee or charge you've ever been hit with? Drop your answer in the comments below.